Last session we discussed half of the book of compounding secrets, and in this session we'll be discussing the remaining half of it. However, I would quickly like to brush up all the concepts that we discussed in the last session. First, I have created an abridged version of the presentation. So we will quickly be just touching upon a few important pointers, so that if somebody has not attended the session last time, they are aware of what was discussed, and then we can move to the next part of it. So the book is divided essentially into four parts. Last time we discussed the foundations of compounding, why equity, and few of the secrets. And today we'll be just brushing up on those concepts quickly, and then moving to the remaining secrets and how to think about compounding beyond money as such. So part one was foundations of compounding. So here we understood that brain is linear. It always thinks in very linearly that we did X thing and we get X result, and we did Y thing and we get Y result. However, the reality is exponential. Everything is linked. Everything, all our efforts echo forward, and everything compounds essentially. And that is why, over a due course of time, the results start appearing somewhere, beyond our expectations, because then there is a power of exponent involved in most of the things that we do, including, of course, our portfolios and our investments. And then we discussed the myth of overnight success, how people think that it is usually a fluke or a matter of chance or luck that somebody becomes successful. However, we discussed a few topics and few examples where we can actually backtrack that how a person has been working hard, or working towards a particular domain since many years, and all those small efforts eventually compound, and one fine day that compounding becomes visible, and people start calling it an overnight success, but actually it is a myth. Then we talked about how, what kind of wrong mental conditioning we have in our society, in our families, even in our schools, that we are not taught how to manage. We are not taught how to manage risk, but we are in general made risk averse as such, because of which we do not take those initial steps when the process looks very boring and plain. That time, we most of us are forced to quit because people want overnight success. So that is the wrong mental conditioning. And people want to believe in magic. That's whether we discuss the Conmanegas role with the example, how people want to just get something very quickly, that we take part in a show and we become a millionaire overnight. But that the chances are very narrow. The chances are very small, and where the chances are high, doing systematic investments, building assets, and actually achieving that crore mark. Most of the people do not want to go there because the process is not that easy and does not look fancy. It is actually a boring process. So that is what we discussed. Next, we touched upon a few stories. I'll just quickly go through the numbers here. So we discussed about the chessboard story, how on first square, if we keep one rise and we keep on doubling it on each square. So at 11th square, we'll have 1,000 grains. On 21st square, we'll have around a million grains. On 31st square, we'll have over a billion grains. And if we combine all the grains of all the 64 squares, including the 64th and the other 63, so it will be 18.4 quintillion grains, which is which is even larger than thousands of years of worldwide rice production as such, if you really think about it. So that is the power of compounding, and that results, they look small initially, but it becomes mind-boggling when time is given its chance and we do multiple number of iterations, sufficient iterations. Then we took the 30 steps example, that if we have to take 30 steps and each step is doubled, so how many steps, what distance will be able to cover? Just by doubling and starting this compounding equation, while taking normal regular steps, by doubling our step size from 0.8 meters, the 30th step will be 4,29,497 kilometers. And all the 30 steps combined would be enough to circle Earth nearly 21.4 times. So that is what we are talking about. That is another thought experiment. Then we discussed the thought experiment of folding a paper, how an insignificantly looking, thick paper, which is just 0.1 millimeter, if we are hypothetically able to fold it 40 times and the thickness just doubles. So this 0.1 millimeter of thickness, when doubled 40 times, it becomes 1,10,000 kilometers in thickness, the paper becomes almost 1 lakh 10,000 kilometers in thickness. And how much distance is this? This is one third the distance of moon. So just by folding the paper 40 times, we can actually reach one third distance of the moon. So that is what we discussed. Then we took more practical approach towards understanding compounding. That if we do an SIP of 10,000 rupees, and what will happen over a course of 30 years. So we will try to analyze that not all returns are equal, and we just took example of three situations where we do a fixed deposit at 6%, assuming 6% interest every month. We just do a fixed deposit of 10,000 rupees. At 30 years, somebody will end up with a portfolio of 1 CR. Now, just by changing the return, when the return becomes 12% with Nifty 50 on an average historically, so this return can look like 3.5 CR. And what we are doing here in Technofunda, trying to achieve a 25% compounding, that will give us a portfolio size of 80 to 80 CR. So just a monthly 10,000 rupees SIP over 30 years, when compounded at 25%, will become 80 to 82 CR, 80 to 82 CR approximately. So that is what we discussed, that how returns play a role in the final outcomes. Then we gone through a few case studies, understanding the power of starting capital. So here we just assume that we are, compounding, at a very decent Nifty 50 rate of 12%, and we are investing it for 30 years. And if we are starting with a lump sum amount of 10 lakh rupees, that becomes 3 CR after 30 years. 20 lakhs become 6 CR. And similarly, 1 crore becomes 30 crores. So we just understood the power of starting capital, that the difference between the first and the last is, not at the starting, the difference is 90 lakh rupees, but at the end, that difference is 27 CR. So how each 10 lakh rupees is giving us a bump up of 3 CR. So that shows that where we start will eventually determine where we end. Then in case study 2, we understood the role of return. Here again, we took a lump sum investment of 10 lakh rupees over 30 years in fixed deposit. It becomes 57 lakh rupees. At 12%, it becomes 3 CR. At 25% compounding, it becomes 80.7 CR. And if somebody is able to achieve a rate of say 50% over, very, very difficult to get it over 30 years, but just if we treat it as a pursuit, because people are being able to do that, there are processes. And of course, AI is there. We have a lot of tools. We have community support. So just as a pursuit, if we try to get 50% and we stay really disciplined and we are able to achieve this mark over 30 years, now see the number, how mind-boggling it will become. It will become 19,100 crores. So long story short, rate of return plays a very crucial role in our compounding. So whatever process we follow, one, we should have a system that is able to work across the market cycles. We should have a long horizon time, and the process should be such that we are able to maximize on the rate of return. Practically, it might be 15% to 50% to 100%. We never know. Mark Minavini has consistently done triple-digit returns. Vivek sir also showed us that how in his satellite portfolio last year he was able to do 100% returns following the same process. So this just gives us the power of role of return, right? So that can be a pursuit, and accordingly we can develop a processes. Then in case study 3, we quickly touched upon the topic that how time can be a true game changer. And everybody talks about 30 years. Here we took a horizon of 60 years, assuming one, if we start really early, if somebody listening to this video starts at say at the age of 18 years, when he's a legal adult and is able to have a PAN card and open up a demat account. And so one is that if we start early and we get more amount of time, so just see that the returns at the final value, 31 lakh versus 65,253 crores. Same 10 lakh rupees capital. In this case, we have assumed a consistent 25%, which essentially means that we are trying to create index beating returns. Another way to think about it could be that if somebody is listening at the age of 30, so maybe at 90 years, somebody can enjoy this portfolio size. And we can also backtrack that at 80 years, we can have 7,000 crores. At 70 years, we can have 750 crores. At 60 years, we can have 80.7 CR. So that is what I wanted to highlight here. Another perspective is that this truly shows that how a portfolio, if allowed to compound for more time, can create magic. So not just doing it ourselves, teaching it to our children, passing the knowledge to the next generation. If we might be at somebody listening to this video might be at the age of 60, but there might be kids at home who might be starting up at 20 23. We can just pass on the knowledge to them, and that is how we can think about it. So again, we try to understand the importance of time as such, and then we can decide upon things our way. And case study 4 was a more practical example where somebody is blending active income with passive income, with passive investing. So now we have taken a practical horizon of 30 years and a starting capital of say 10 lakh rupees, um, comparing different rates of returns. And after 10 lakh rupees, say from next year onwards, we start a 10,000 rupee SIP henceforth. And then we try to bump that SIP by 10% annually. So at different rate of returns, this corpus in FD alone can become 4.2 CR. So that tells us how important active income is along with passive income. Because see, in this case, 6% return, the lump sum contribution was 57 lakh rupees. But just by doing an SIP in FD alone, there is a bump up of 3.62 CR, making a total corpus of 4.2 CR. So that is why blending active and passive income is also very important. If somebody feels that I have a decent corpus size, I need to retire right away, that is definitely a person's choice. But blending active income becomes even more powerful because fuel of compounding in this case is the capital, and active incomes gives us a leverage. And if somebody skills takes their skills up and even the earnings up, so instead of doing a 10,000 rupees SIP, you can think about higher amount of SIPs. So that is a fourth case study that we discussed. And final return here, the 10 lakh rupees starting capital, 10,000 SIP with 10% annual step up, 30 years at 25% rate of return. Somebody can do a 152 CR corpus in 30 years of horizon, right? Then we came to the next part, which is compounding through equities. So here we try to understand that how action taking is important, and why compounding, why equity is one of the most powerful assets when it comes to compounding. And we try to discuss that when we earn, it is not equivalent to saving. When we save, it is not equivalent to investing. And when we invest, it is not equivalent to investing it wisely, because we understood that different rate of returns carry way different outputs. So to become wealthy, the most important thing is to earn, save, and invest wisely. So on that note, let's continue. Then we looked at the cash flow quadrant, popularized by Robert Kiyosaki in his book Rich Dad Poor Dad, and we try to try to understand that how the third and fourth quadrants are the dream quadrants when it comes to wealth creation, and how equity gives us access to these quadrants instantly. Even if our portfolio size is small and we have a demat account, immediately we are able to invest in companies, and that is how we get instant access. And when we start doing it very professionally, and we can make this in itself a business. So just equity investment can give you access to becoming a business owner, and becoming an investor instantly. Then we understood that the more important thing than earning is what we keep. And we took two simple examples of Raj and Rahul. Raj had a 2 lakh rupees salary, while Rahul had, say, 1.5 lakh rupees of salary. Raj spent everything. Rahul saved 15,000 by cutting down on his wants. Of course, he took care of all his needs. 1 lakh rupees is not a very less amount of salary as such. And 50,000 rupees saving is a very powerful saving. So we just try to understand that even though Rahul is earning less, but just by having smarter choices, and just by intentional saving, Rahul is definitely going to have a brighter future, because he is investing and saving, while Raj is spending everything, or worse, maybe he's taking loans. So then we understood that what the right formula should not be whatever is left after spending should go to our savings. Ideally, the formula should be that whatever we earn, we pre-decide that this much amount we want to save. And as soon as the salary or the profit in our own companies reflect in our bank accounts, we immediately take out certain portion of savings, invest it, and then whatever is left, we try to maintain our expenses in that amount. So that was a key learning here. So again, that then we discuss about how technicals and fundamentals are like yin and yang of equity investments, and the debate is not either. That either should it be technicals or should it be fundamentals, because these are not two different things. They are actually complementing each other. They always complement each other. They are like yin and yang. That although they might look they have a high contrast, but they are always complementing in nature. So fundamentals and technicals, both of them, they answer different questions, and that is why we should stop treating them as rivals, and otherwise it will create blind spots. And if we combine both the lenses, then we can make better decisions. And we also understood that how technicals matter, for longer period of horizons, because fundamental investors are usually long-term investor, and how technicals can help us get an edge even, and more particularly in longer time horizon, is what we will understand in the subsequent chapters. In part three, we started discussing the compounding secrets. So in the book, I have covered more than 30 secrets. Few of them might be bulb-on moments for the audience, for the people attending this session, and a few of the secrets might just be refreshers or might be plain, very simple fundamental things. But it will still act as a reminder that how important these small things are. So secret one was that all chart patterns gauge the demand and supply equilibrium. So here what we try to understand is try to understand was that instead of obsessing over the pattern, that what pattern is forming, we should go to the fundamentals of it, that essentially how the demand is how the supply is shifting towards demand, and where that demand supply equilibrium is getting tilted in the favor of demand. So we discussed multiple chart patterns. For the sake of brevity, we are just discussing, revising this too. Even in rounding based pattern, how the supply is dominated initially, then the supply gets exhausted, and when there is structural trend change, then the demand starts rising, and we get our entry points. Similarly, in consolidation phase, the demand and supply is actually at equilibrium, and when there is a growth trigger, the price goes beyond the pivot. That is where the demand starts overpowering supply, and that is where we should our ideal entry points be. So whatever the chart patterns, ascending triangles, descending, and whatever trend lines, whatever. But what we should understand is that if there is a shift from supply to demand, that is the precise point we should start getting interested in a particular stock. Next secret was that we should be the last weak hand. So the whole market can be classified into strong hands and weak hands. And what we try to understand is that entering at the right time is important, riding the wave completely is important, and then exiting at the right time is also very important. So instead of becoming a strong hand at the top and becoming a weak hand at the starting of the trend, what we should be doing is that we should enter at the right time, ride the wave fully, and we should be just there at the door. We should be the last weak hand, that we are not weak enough to make a premature exit. But as soon as there is a trend shift, we declare ourselves weak hand, that okay, we are the last one, and we take an exit and let the strong hands keep holding them, because eventually when the trend changes, there might be correction and it will hamper the compounding as such. Secret number three was that even if somebody is not able to enter at the right time, even if we are late, the late entry can be compensated with better allocation. So we discussed how low cheat, mid cheat, and breakout entries play out. And the best time is to enter at low cheat, then at mid cheat, then at breakout. But even if somebody is entering late, say here somebody would have started with 1% allocation, or say 0.5, 0.25% allocation. If somebody is taking a breakout entry, then maybe we can have a higher allocation to compensate for the lost returns. That was one thing. And even when the trend has started to play, and we think that there is a structural trend which can last for 10 years, and we missed out on the ideal entry point. And say it is a very powerful sector where we think that it might give us a CAGR of say 40, 50% also for a longer period of time. So that time what we can do is we can simply try to find points where the pullbacks are happening, and we can try to see where the EMS, which EMA the script is following. And accordingly, we can try to set a trailing stop loss in such a manner that the percentage of trailing stop loss is less. And for maintaining the same amount of risk, now we will be able to allocate more. So even if we are late, that late entry can be compensated with a better allocation is what we try to understand here. Of course, the risk should not be overlooked. Doesn't mean that if the breakout has happened, the stock is extended. I do not intend to say that we should be entering into extended stocks. But if we are entering into an extended stock, whenever it gives us tightness or it pulls back towards an EMA and gives us a very low risk 2-3% kind of entry, then we can take higher bets and say maybe say we can straight away go 5% of allocation, because now the confirmation is there that the trend is started. We are just risking say 2%. So 2% of 5% allocation will be again 10%. Even if we give it a 3% leeway, so that will be 15%. So since probabilities are in our favor, so by doing that, even going all in one shot or maybe in staggered, whatever, however you want to go. But the key point is that it can be compensated stated with allocation access. Another way to look at it is late entry in the market itself. So suppose if we would have entered in the market at say 18, 20 years of our age. So that time a portfolio would have been a few thousand rupees. Of course, we would have had the time advantage and there's nothing better than that. But what we can do today is that we can try to prioritize our investments. And even though we have lost on a lot of time, what we can do is we can now have a higher allocation instead of say starting with 10 lakh rupees. Who there is no rule that we should start with 10 lakh rupees capital. Maybe we can start with 1 CR of capital if somebody is able to take that amount out. Maybe somebody can start with 20 lakh rupees of capital. So even a late entry in the market itself can be compensated with better allocation if you really think about it. It is just a matter of understanding the power of compounding, prioritizing, and a lot of people have investments in real estates. Maybe we can just dilute one of the asset and put 1 CR in equities. So that is what I want to bring about here. Secret 4, yeah. If there is any question, so please feel free to stop me and we can have a discussion on that. So I assume everything is going fine. So should I proceed?
Yes, please proceed.
Yes, yes.
So in Secret 4, we discuss how market leaders move the market. So especially when we are coming out of a downturn, like right now. So when the market starts turning, so even before at index level, when we are able to confirm that the market has shifted, there will be a lot of scripts which show either strength or they make new highs or they show turnaround. So those are essentially the market leaders. So the idea here is that when the market is moving, it is not moving because of the laggards, because laggards are still, they are still at very low level of prices. The market starts moving because of the leaders. And what once a momentum is picked up in a particular script, that momentum usually continues. So the idea here was that instead of waiting for the full turnaround, like say in current situation, if we have to think about it, so instead of waiting for a breakout at Nifty level, when the stocks are, there are the pocket of strengths are becoming visible, but Nifty is not favorable. That time, maybe we can start getting interested in those scripts by either researching or by taking very small exposure of 0.25%, 0.5% kind of tracking positions, so that at least we become part of those leaders because they were showing strength. Whenever the market turns, they are going to move forward. So instead of waiting for the complete turnaround, we should start getting interested. We should start doing our homeworks. We should create alerts and GTTs, and we should create our watch list. Because when the market moves, these leaders will move more than the market. And usually, if we wait for the full turnaround to happen, a lot of steam would have been lost. Then in the next secret, okay. Just a moment, please. I think there's a glitch. Yeah. Yeah. Then we discussed the secret number 5, that a quick fall without a change in fundamentals is somebody else's opportunity to buy. So whenever the fall happens, it just happens. Sometimes it happens so fast that we are even unable to notice that when did this happen. We open up our demats and the stock is already down. So that is totally okay because a lot of times the fall happens even at 9:15 a.m. The market opens and due to the aftermarket orders itself, the stock is down. So falls are very natural in market. The volatility is the toll gate of entering in the stock market as such. So that is how we should look at it. But what we need to see is that after the fall, what is happening? What is the follow-up move? So here we just compare two examples of a tennis ball and an egg. If there is a sharp fall, and fundamentally nothing has changed. There is just a sharp fall because of whatever reason, maybe market condition, market sentiment, sectoral sentiment, or whatever. Now, somebody who knows the power of this company in the long term and long term triggers, wait. Usually, those people wait for such a kind of falls. And what will happen that since the demand was there, this fall is actually an opportunity for somebody else to buy, and then it sees a strong demand, and the stock quickly bounces back as a tennis ball. On the contrary, some stocks are like when they fall like an egg and the demand is missing and then there is no sharp recovery. So particularly when the fall has happened and there is no recovery and our exit has triggered, we should not stay in a hope story. If the demand is missing and the stock is not bouncing back quickly, we should take an exit call. And whenever it is bouncing back quickly, we should just tighten our exits maybe because the fall has happened. So we want to stay alert that it might not go further down. So maybe we can tighten our stop losses, but then we can give it some more room, some more time to see if the base is building again and if it is ready for a fresh breakout as such. Then in the next secret, we discuss how technical analysis is more powerful for long-term investments. So usually fundamental investors do not want to do technical analysis because they have a longer term horizon. But just by increasing the length of our investment horizon, when we are using technical analysis, essentially what we are doing is that we are doing the same thing that we do in shorter time frames, avoiding consolidations, not participating in downtrends, and taking maximum part in the uptrends. That is essentially what we are doing. But just think of it in this way that when the horizon changes, our time frame changes. And if a consolidation on a daily chart is for say 12 days, a consolidation on a weekly chart will be for 12 weeks, and a consolidation on a monthly chart will be for 12 months. And 12 months is a big period. And for some companies, this consolidation can also last up to say 36 months, say 3 years of compounding loss. So that way, technical analysis become more powerful for longer term investments because now the trends matter even more. Whatever consolidation is structural, downtrend is structural, uptrend is structural. So that way, it becomes even more powerful for long term investments. It's what we try to understand. In secret number 7, we just compared the same stock of Aisha Motors on 3 different time frames. And we understood that when we expand our horizon and we lengthen our horizon, the noise becomes less. So the same chart on daily time frame, weekly time frame, and monthly time frame. Daily time frame has a lot of volatility. If you would have had to use any sort of trend following indicator, very difficult to write this stock that way. But on a weekly chart, that noise is pretty less. And since this is a structural story, on monthly time frame, it is even cleaner. Whatever these down moves, gap downs, gap ups are there, they are not at all visible on a monthly chart. So if we have to reduce the noise, we just need to switch our time frame to a higher time frame. So particularly what we see is understand is that for core, it is better to follow monthly time frame. For satellite companies, it is better to follow a weekly time frame. In secret number 8, we understood how no one can predict, but everybody can stack probabilities. So we of course cannot predict, but that does not mean that we should stop investing in stock market as such. What we should instead be thinking is that it is a game of probability, and there could be multiple ways to stack probabilities, and everybody can do it. It is a learnable skill. So that way, we should stop predicting that what will happen tomorrow, and we should start preparing ourselves for whatever happens. If there's a breakout or a breakdown, we should have a system for that, and we should try to stack a lot of probabilities so that ultimately we develop a system which is a win-win system in the long run. In secret number 9, we discuss how each tranche compounds. So even if initially it looks pointless that why are we tranching, and instead of going all in, why we have to stagger. But what happens is that when the stock moves in the favorable direction, actually each tranche is compounding. So this is giving say 70%, this is 60%, 50%, and so on. And what will happen is that this 70%, the first tranche is anyway, compounding a lot. Say if somebody gets a 2x, a lot of times it feels like that we are able to because of tranching, we are able to do only 50% instead of 100%. But that first tranche has compounded 100%, second might have compounded 90, third might have compounded 80%. And it is not less actually, if you think about it, because when we keep playing this game, even the tranche sizes will eventually become. The 10 lakh rupees portfolio gives a 10,000 rupees 1% tranche, but a 50 lakh rupees portfolio will give 50,000 rupees of 1% tranche. So eventually, when a portfolio size increases over time, now these 1% and 0.25%, 0.5% will also start to carry more value, and each that movement will actually add to our portfolio results. So that way, we should even like think it this way, that every tranche is compounding. So we should be happy whatever gains we have, but we should just look at it with this lens. In secret number 10, we discuss how lower time frame leads to lower gains and higher time frame in the same stock can lead to higher gains. Here we took the example of Mazdoc Doc. So when the script first came in everybody's radar, so that time a lot of things were changing in this industry, in this sector as such. And Mazdoc Doc was one of the beneficiary. Whoever wins, they win the most. That kind of thing. So when we have certain stories which have higher triggers or higher order books, or when they have stronger moats in comparison to the, even though defense is not a core sector, but if we, even in a non-core sector, if we try to find one companies with strong moats that will structurally benefit for a longer time, so that time it might make sense to go for higher time frames. And second way to think about it is that even if we start tracking a company on weekly time frame, if it has given us good margin of safety, good gains, and now we think that it can become a structural story also, so we can now switch to monthly time frame because we have a lot of margin safety. And we'll quickly see how for the following the same exit system of 20D EMA and same entry point, different gains are there on different horizons. So for a daily time frame, the stock gave a 85% gain. On a weekly time frame, same script, same setup, but now the EMA becomes 20 weekly EMA, and now we are able to clock 123% of gain, significantly higher. And if somebody would have just believed that, okay, this is the ultimate beneficiary of the defense sector, and maybe we should now, after having enough margin of safety, now maybe we can move it to a monthly time frame. So that way, the same entry point would have eventually given 400% gain. And as on 15th December, there was no exit. I'm not sure what is the scene now, but there was no exit even there on a monthly chart. So this is what we discussed in the last session. Now let us continue to the remaining part of the book, where we'll be diving deeper into the remaining secrets and then discussing how compounding can be thought about beyond money as such. So chapter 9 is about time frames, pivots, and allocations. And secret 11 is the time frame is proportional to patience, and patience is proportional to returns. So think about it. If you meditate more, we make more returns. So this is just something like that. Because for, like we were discussing, that a consolidation of 36 candles on a monthly time frame is 3 years, and a consolidation of say even 6 candles on a monthly time frame is 6 months. So holding on to a script, making no returns or maybe slightly negative returns over 6 months requires some sort of patience. And that patience will eventually guide that if we are able to follow weekly and monthly time frames or not. And higher the time frames, higher the gains. We have already seen that. So this essentially reiterates a point, but with a hint of mindset, that we need to work on a mindset. And when we are able to develop, become very patient in the process, we will be able to then invest on higher time frames. And only when we invest on higher time frames are we going to get exceptional returns. Next secret is that pivot is a logical buy point, but it is not a magical buy point, right? So let us take example of this chart here. A stock forms a top at point A. Something changes in the company, maybe the market condition or the company is degrowing or the valuation has become stretched and the price starts correcting. It comes down to bottom B, it forms a bottom here. And now the price is again turning around. So between point B to point C, there will be a lot of selling pressure by all the trapped buyers here, because these guys will be like that, yeah, this stock is very bad, same as gone dog, somebody holding on a daily time frame. They thought that this will become a 400x, a 400% gain, but they are on a minus 50%. So whenever this guy is at minus 10, minus 20, minus 30, minus 40, minus 50%, right? So whenever the price is turning back, all these trap buyers will say that the story was bad. It is not a 400% worth of stock. I have gone very down. I will sell. So that is the concept of trap buyers. So whenever the price again now starts going up, these trap buyers tend to sell, because of which there is always a selling pressure in this zone as such. And the final shakeout can happen at point C. And once the final supply is squeezed out and the price decisively breaks out of this pivot point here at point D, and it is supported by a strong volume, meaning a strong demand is there for that script. So this point becomes a point of least resistance, which means that at this particular point, everybody who was invested in this stock since time immemorial would have been in profit as such. So that mentality of getting trapped in the stock is now gone, because of which this becomes a very logical buy point, that logically we should be buying here because here nobody's trapped. Whatever the company fundamentals are there, at least it will reflect in the price. There is no no issue because of the trapped buyers. So this is a very logical buy point if you think about it. But having said that, it is not a magical buy point. What does that mean? That when we practice breakout entries, some of the stocks will explode like anything, while some of the stocks will just respect that pivot point, or maybe they will slightly form a small handle, or they might just respect the EMS and they might not explode. Recent example being, say, GE Shipping. Everything is logical that okay, it is a beneficiary of the war and all these things, and because if you do a very deep analysis of the company, structurally also they have started to deliver good returns. So this might be a trigger, but even structurally they are in their balance sheet is in a good shape. So the breakout happened. It did not give you a boom kind of breakout. Maybe the price corrected a bit, but it still respected an EMA. And now it is trying to turn around, and now it is trying to break out. So does that mean that we should be selling that stock because it did not give us a boom kind of breakout? The answer is no, because it is not a magical buy point that here some magic will happen. Okay, it did not break out like say another script which would have gone 10%, 20% after the breakout, but still it is there above. No, it is still above the EMA. That story is intact. Nothing is changing. The exit is not triggering. So to avoid premature exiting, we should lower down our expectations from breakout, and we should stay patiently till the exit is there. When the exit is triggering, we should go out. Otherwise, we should just stay in and we should follow the process. Next secret is that disproportionate portfolios give a disproportionate edge. So if we invest like an index, we are gonna get returns like an index. If we want index beating returns, we have to create disproportionate portfolios. Here also Pareto principle applies, and whatever we do, whatever our research is, whatever tools we follow, we see technical fundamentals, eventually the hard truth is that approximately 20% of our companies will become winners and 80% will either be average companies or will be laggards. So here, for example's sake, we have taken 10 lakh rupees portfolio, 20 stocks in the portfolio, 16 are laggards or average, and 4 of them are winner. So even the 16 stocks have given a decent, say, 8% return, average returns, while these 4% stocks have given a 40% return, not 2x, but 40% return. Okay. So here we see if the allocation is same for all the stocks. Portfolio impact is 80,000, 64,000 respectively. And overall at a portfolio level, by investing these 20 companies, one will be able to do 14.4% of returns, which is that the portfolio is roughly tracking the index. But if we skew the equation and if we allocate more to the winners and less to the average or laggard. Now see here, the average allocation per on the laggard is 31,000, but average allocation on winners is 125, almost four times the price, like 1:4. Say on 16 companies we are invested just 1%, and on four companies we are invested 4%. So just by doing the simple math of screwing up the allocation, these four winners, because of a higher allocation, will give you 2 lakh rupees at portfolio level impact. And the remaining 16 stocks, because of the low allocation, will give a 40,000 rupees of impact. And overall, now that same portfolio has compounded instead of 1,44,000 to 2,40,000, which is like 24% of portfolio return. So just by following this small philosophy of allocation, it is very easy to actually beat the index. Same stocks, no new script. We are just changing the allocation in the existing 20 stocks, and 16 of them have become laggards just by finding four winning stocks and allocating well to them by doing a 40% average return, assuming that say these four became double and whatever happened in the process, we could actually very easily beat the index as such. So same stocks, same win rate, but significantly higher returns. So far, I believe it's going fine. If there's anything, if somebody wants to have a counter argument or maybe discuss in more details, please feel free to interrupt or stop me, and we can take that discussion forward. Right. So on that note, let's come to the next secret, which is secret number 14. So if you try to think, so in the book, I have tried to mention, whatever I have experienced as going through the investment process, whatever emotions I have felt and whatever solutions I try to find and whatever inferences I have tried to understand, I've written it like a crux, and I have tried to put it in forms of secrets, because these are like compounding secrets, very small tweaks, but each tweak is quite powerful to eventually change the portfolio level returns and the long term returns, if we think about it. So all of them are like framed like like quotations, so that whenever somebody feels stuck and have doubt regarding the process, they can just go back to the book and just go to that particular secret, maybe 2 to 3 pages for that particular concept, and then we move to the next. So there are like 30 plus secrets, and now coming down to secret number 14, it says that pyramiding increases returns. And there are many ways to pyramid. So we understand that if we take equal tranches, something like this, the average by pricing price will be somewhere in center. 1%, 1%, 1%, 1%, 1%. This is the average buy price. But if we would have same strategy, if we would have followed pyramiding, that this is say 2.2%, then this is 1.5, 1%, and 0.8%, whatever. So in this case, the average buy price will not be here, but it will be lower. If this was the exit point, it makes sense that this will give you whatever return. This strategy will give you larger return. So this secret simply tells you that what is the power of pyramiding, that by pyramiding, we bring down the average buy price, because of which our overall return on a particular position increase. But this is not the only way to pyramid. There could be multiple ways. Just giving two more examples of reverse pyramiding and asymmetric pyramiding. Where in reverse pyramiding, we are starting very small, because here the confirmation was less. There was a probability of track buyers butchering our position and the overall stock movement. So we went very low on position sizing. And as we reach the mid sheet, we at least understand that this is a decisive bottom. So that way, probability is higher. We say added more. And when the breakout happened, now we know that, okay, there is no scope of trap buyers. So we add more. And when there is a subsequent follow-up move, so which means now pullback has also happened. And now it is a pure decisive, stage two. So when we have that sort of confirmation, then we add the highest pull. So this kind of reverse pyramiding can also be done. And still the average buy price will be lower than the equal tranche, because we are starting early. And this is a very powerful example to highlight how starting small can actually bump up the returns. Because if you compare these two cases, just by starting early and starting small. When everybody was fearful, we entered the stock, say if the Nifty is in downtrend. So instead of going for breakout entries, because breakouts will fail when the market is not favorable. What we could have done is that we could have just gone to the blue list, and wherever the bases are forming, we could have just taken say 0.25% in 4 to 5 scripts and stayed there. We are not exposed too much, because of which there is a too much downside risk. But at least we are participating early. When everybody is fearful in the market, we have we just put our 0.25%. And when the market decisively turns and when the market leaders start breaking out, then we can have the highest allocation. And that way, just by starting small and starting early, we will be in a better position than these investors who were waiting for a breakout. So that is a part of reverse pyramiding. And we can also do asymmetric pyramiding also, that instead of going completely reverse, we start small, we wait for the breakout, and after breakout, we again start tapering. So that way, the average buy price will be now even lower. So this is, if you think about it, this is the most efficient way to do it. We start small, then we take say 2-3% near breakout, and then we again start to taper. So that way, our average buy price will be almost at the breakout level. So this is equivalent to somebody putting all money at the breakout level and then riding the trend fully. We are almost there logically, but never, at no point of time our risk was same as the person who would have invested in one shot. So that is the power of tranching and pyramiding as such. And there could be multiple ways to do it. I just wanted to highlight that there are multiple ways to do it. So whatever process one is following, we just need to be creative in our tranching as such. So this completes chapter 10. In the next chapter, we will understand how to read results and how to read the market reaction. So a lot of time, especially when we start a journey in stock market, what happens is that what looks like a great result, next day there is a 10% fall. And as like new investors, we are like that this is cheating. But that is the harsh truth of stock market. When the result sometimes is not looking very great, still the stock keeps on performing well. And when the result is looking fantastic, still next day there's a 10% down or maybe a gap down move. So that is the harsh reality of market. And what we need to understand is that it is not just the result, it is the result in comparison with the expectation of the market. How good or bad is the result in comparison to the expectation of the market is something we need to understand, because ultimately market is forward looking, and in the subsequent secrets we'll understand that how can we gauge the sentiments, that what was priced in and what was not, and accordingly position ourselves. So next secret is that solid closings give solid results. A lot of times what happens is that the quarterly results are due, say the results are due on say coming week, next week, but the stock has already formed all-time high. It is getting good volumes, the breakout is happening. So instead of waiting for the quarterly result and then getting in, what we should be seeing is that there is a demand in the stock. The results are due, the demand is already coming in. That means somebody is either in the market is either smart enough to understand that how this company performs. Maybe H1 or H2 is stronger for that particular company. So they kind of have understood the cyclicality of that particular industry or that company, because of which they are betting that, okay, the quarter will be good anyway. Or there is some sort of insider news, or maybe the promoter might be buying. So the bottom line is, whenever the price is moving and the result is due, it is still moving for some reason. It is just that we do not understand what that reason is. But as a techno fund investor, if we are seeing good breakouts, good turnarounds, good base completions, good volume buildup, instead of waiting for the results to come, we should anyway start taking our position, relying on the price volume. And then maybe a subsequent addition can be done after the results. Because usually what has been seen is that if there are solid closings, usually the result is also solid. That way. Next secret is just the reverse of this, that whenever there is a solid result, and if it is actually very solid, then it should have solid closings. So what do I mean by solid closings? Whenever there are candle formation, the green candles should have very less wick. So if there is no or very less weight, that means it is a very solid candle. It is fully filled up that candle. So if the result is actually very solid, it looks good on the papers. But if it is a very good result as such, then the phenomena of post earnings announcement drift should kick in. Because if it is not kicking in, there might be two possibilities. Either the result is very temporary and it is not sustainable, or there is some sort of accountability issue, or there is some sort of you know issue in the earnings as such, which we are unable to understand. So we have to more look at the quality of earnings instead of plain earnings as such. So that might be the issue, that the quality of earnings is not good, because of, even though the result was looking good, the follow-up moves are not that good. And if the follow-up moves are not that good, so maybe we should not, fight back that our result is good, I will just go long on this position anyway. We should then go to the drawing board and see that what the actual issue is. And until we get a good follow-up move, we should not be adding to our position. So solid results should ideally be having a solid closings as follow-up moves happen. Next secret is also pretty interesting. It says that we always have a law of limited choices. What does that mean? It means simply means that we need not chase every story. It is said that we cannot marry every girl on the street. Similarly, we cannot buy every stock in a portfolio, particularly when we are in a community setup, or when we have access um, uh, to a lot of influencers or a lot of social media exposure, and we have a habit of reading the newspaper or seeing the news channel. We are going to get a lot of investment ideas each day, but the harsh truth is that there is only so much we can invest. It is not, and it is never about the portfolio size. If it is 1 lakh rupees of portfolio, or if it is 100 crore rupees of portfolio, for meaningful gains, we should not be investing in more than say 20, 30 scripts, because above that, tracking becomes really difficult. And there are a lot of biases that come in, and not just fundamentally, but what is happening in terms of return. We are, a lot of mental bandwidth is consumed. So we should start thinking in percentages instead of thinking that, okay, I will be investing 1 lakh rupees in one stock max. Instead of thinking that way, how we should be thinking is in terms of percentages. That I will be starting a position with 0.25%, or I will take 2% trans, 1% trans, and I will go maximum 5% allocation, 8% allocation. So once we are able to fine tune our brain in terms of percentages instead of then sky's the limit. Even if we have a 100 crore portfolio, the process of managing it is no different from managing a portfolio of 1 lakh rupees. So that gives us longevity also. And anyway, we are limited by choices, right? So that way, since we know that we can only take 20, 30 positions, even if so the bottom line is that we should be, not be very hard on ourselves in entering every stock, because what we need is just a handful of full of few of winners. And when we get that winners, we need to allocate well and write them well. That is the ultimate rule. And whatever the portfolio size, we cannot go unlimited, because any capital is limited capital, even if it is thousands of crores of rupees also, still it is limited. So anyway, those choices will still be limited. So that way, just be happy with whatever you have and try to refine the process and the portfolio. So next secret is also pretty interesting. It says that we should be chasing excellence and not perfection. Because when we try to find a perfect time, when we try to find a perfect stock, when we try to find a perfect process, what we end up losing is time. What we end up losing is even experience that we get from the mistakes we do. So, what is important is doing. Even if we are doing wrong, we learn something. If we are doing something right, we will earn something. But it is important to do. So, that way, what we should be chasing is excellence and not perfection, because rational decisions optimize for outcomes. Right? Okay, I would have got 100% return instead of say 80%. That would have been a great thing. So if we try to be a very rational about everything, so we'll be optimizing for short-term outcomes, because anyway, one script is going to get out of our portfolio anyway if the things change. But if we are doing reasonably well, that at least we are investing in equity markets, that in itself is a very big uh, game changer, because not everybody is aware We have a community setup, we have a learning setup, we have learning resources. So that way we are doing reasonably well just by participating in the stock market, just by learning, we are doing reasonably well. So when we take these reasonable decisions, even if we are unable to do say 25% on day one or day or first year, second year, third year, but if we keep doing it and doing it reasonably, that a reasonable bandwidth is consumed, a reasonable loss is taken, a reasonable profit is booked. If we are just reasonable enough, that way we'll be optimizing for long-term survival instead of short-term outcomes. So that is why instead of becoming very finicky about each and every interaction and getting glued to the screen, what we should be doing is that it should be an excellent process, and it should not. If it is okay if it is not a perfect process. And of course, there are hundreds of paths to nirvana, or in this case, say financial nirvana, that is financial freedom. So there are 100 paths to do that. Somebody who does not take part in stock market altogether, but uh, understands how to invest in real estate, understand where the low hanging fruits are, where understands where um, those turnaround opportunities are there. That is also a path to nirvana. People have become financially free by investing in real estate. Somebody just used to invest in gold and they would have saved a lot. That is also part to nirvana. Even if somebody did not invest anywhere, just put it in FD, and we saw that what a good habit of saving and even investing in FD can do over a long period of time. And that person simply has, maybe lower headline returns, but also has low expectations from life. They have lower wants or needs. Then also they're financially free. So there are hundreds of paths to do it. It is just that we should try to find which path is most suitable to us. And it is always the optimization versus what we have to spend and what we can, earn actively or passively. So there are hundreds way to do it. This book highlights certain ways to do it, but there could be a lot of other ways also. So that way, the concept of lifelong learning and keeping an open mind, always ready to learn more, always ready to getting corrected by others, is actually a superpower because it is never just one path. There are always a lot of more paths there. Next, I have tried to highlight that how technology plays an important part, and we should almost like marry technology. We should not be dating technology, but we should be marrying technology. That technology is an edge instead of it frees up a lot of time, it frees up a lot of mental bandwidth, because of which we will be able to take better decisions, and ultimately those better decisions will give us better returns. So when we have the option of setting alerts, why look at the screen? Just set an alert and forget. Whenever that thing for which we wanted the alert happens, we are going to get a notification and we can act on it. If we think that we want a perfect breakout entry, maybe we can just set a GTT. If we have to objectively take a decision that at 15% fall, I have to trim 50% of position, just set the GTT. If we have to objectively, really objectively do it. So technology gives us a lot of edge in terms of research and execution. And in today's time and age, it is not a point of differentiation, but it is a point of parity. So just befriend technology, and wherever you are in your journey of befriending technology, just try to make better relationships with the technology and use it to the extent possible, to the maximum extent possible. So that will make the overall process very peaceful. So this completes chapter 10. Now moving on to next chapter, which talks about how we can eliminate the role of luck and how can we ride longer trends. So we have also discussed this before, just reiterating again that iteration reduces the role of luck. Again, I took a very simple example of tossing a coin because this clarifies it instantly. If we have to toss the coin, say 6 times, maybe we'll get say 5 times head and 1 times tail. Doesn't mean that the probability is not 50-50. The probability is still 50-50, but in less iterations, the role of luck was higher. But when we toss 60 times, the balance is improving. And now, say 35 times we get heads and say 25 times we get tails. But if you see the exact percentage, that percentage is closer to 50-50. But when we toss it 600 times, then the probability of getting 297 heads and 303 tails maybe is more likely. And the probability is maybe say 49%, 51%, which is very, very close to 50%. So what we understand from this example is the more iterations we can have, the role of luck will reduce and the role of probability will improve. So as an investor, we are stacking probabilities, we are finding high probability setups, we are checking market condition, we are setting our stop losses, we are following our weeklies and monthly time frames. So what we try to understand is that whenever an exit is triggering, treat it as an opportunity to reiterate instead of thinking, "Okay, oh, I love the stock and I have to exit this." I was thinking that I will make maybe 5x at least, or not, if even not 5x. I was thinking that I did perfect tranching and this was a sure shot winner. This should have been a 2x, but I am getting only 40% return. So instead of punching yourself down, just think about it that this is giving me an opportunity to reinvest and reiterate. And when we are reiterating it, maybe the stock was meant to make 100% returns, and maybe it will after going through another correction, that it comes back again, starts going up. Maybe it will make. But even if you're getting out, it is okay because one, our portfolio size would have increased with that 40% of return, and our tranche size in itself is increasing if you're following the process correctly. Second, when we are doing it again and again, maybe last time it was luck because of which we could not make the returns. But when we are treating it as an opportunity to reiterate, after doing multiple iterations, eventually the probability will start working in our favor. And since we took care of all the probabilities, eventually we are going to win in this game. So next secret is that EMAs are like X-rays of sentiment. So one thing we can very easily judge in the stock market is results and earnings. What is very difficult to judge is the sentiment around it, because the whole game becomes really complex because of this one thing called the sentiment. And how to judge these sentiments? The answer is EMAs. So these EMAs are like dynamic support lines on the chart, and we can set different intervals, and on different time frames we can see different interval EMAs. Maybe we can lay over EMA bands, and we can treat them like, if there is a faster EMA and that is getting breached, that means there is some negative sentiment. If there is a slower EMA and that is getting breached, that means there is a higher negative sentiment. But if a very slow EMA is also getting breached, maybe on a very high time frame, then maybe the sentiment is very strong negatively. And same thing applies to the positivity also. But what we can see is that if you have to gauge that how strong the positive or negative sentiment is, EMAs are the way to do it. One, we can see the EMA's divergence and try to understand the trend strength. Second, we can see that which EMA is getting breached on which time frame, and accordingly we can gauge that if the sentiment was like very low in terms of negativity or it was very strong in terms of negativity. Right? Then secret number 23 is that compounding is very powerful, but negative compounding is equally powerful. So at no point of time, we should let negative compounding play in our portfolio, because if we do not take care of our exits, if we do not become ruthless in our exits, we are going to invite something called as negative compounding in our portfolio at some point of time or other. And if you just look at this chart, we followed tranching and the price was going up. We were in profit. Each tranche was compounding. But when the stock price starts correcting, now the train has switched gears. It is now returning back. And if we do not exit early, if we are say exit here, okay, we might have made less gain here, or even if we exit here, maybe we would have made loss with these two tranches. But if we do not take an exit here and we take exit somewhere here, now we are not just losing on 5 tranches, but this first tranche is compounding negatively. This is also compounding negatively. This is also compounding negatively. This is also compounding negatively. So what will happen is that when the price starts correcting, and once it starts going down below our average buy price, so the 10% move down move will not be eating up 10% returns, but it will be eating say 20-30% return in that position, and we'll come in panic that what the hell is happening? Why is it? Why are all of my profits eroding? Because of this simple phenomena that what was positively compounding once has now started compounding negatively. So hence, it is very very important to exit, take a timely exit now positions whenever the system is triggering exit as such. Now coming to another financial aspect of financial understanding of sorry fundamental understanding of our companies. What matters most fundamentally, if you think about it, it's just three M's. One is margin, because margin are the financial backbone of the business. If a company has a very wafer thin margin, it might be doing great because of heavy volumes, but think about it, what is the margin of safety there? If a company is doing say 4%, 5% kind of margin and has a very high volume, and there is some any sort of disruption, say increase in price, or there are some supply chain issues, there are certain receivables, whatever, the margins are so thin that even if the management was good, the business was good, it was a monopoly in its industry, it was a market leader, whatever, but the margins were so thin that it is very fragile. The business might be very fragile because of this wafer thin margin. On the contrary, if a business is earning say 25% of margin, if something happens, something goes wrong, that company might at worst be earning say 15% of margin. So that 15% is anyway better than a lot of companies because that room is there. So that way, for longer, when it comes particularly to longer term compounding companies, the first M that matters the most is the margin, because it is the financial backbone of any business. Second M is management, because management is like the sailor who is steering the ship, and whatever happens, the the storms are violent or if the water is calm, whatever happens, the management is the sailor who needs to steer the ship or a particular company out of those waters. So second thing is management, because they will eventually decide that where the company is heading to. And third thing is more moats. With good margins and even with good management, if there are no moats protecting the business, competition is bound to come in, and when the competitors come, a lot of time it makes it very difficult for the business to keep growing at the same pace profitably. So if you have to really focus on very few things for checking our long-term bets, I would recommend that we should see what are the margins, how is the management, and what are the moats protecting that business. Next secret is 0.25% position to 25% portfolio return. It is very counterintuitive that how going small can create big, but that is the truth, and we have already discussed about it before. So I will not be explaining a lot, but what we understand from this is that sometimes going small is the answer to getting big, particularly when the market conditions are not right, or even if they're right, when we are entering a new stock, going overboard is never the answer. Starting small, taking that initial instead of plunging in the water, it is better to test the water first, and then as and when the company is performing in our favor, only then we'll be adding to our winners, and that creates a disproportionate portfolio, which eventually gives us a disproportionate edge and can help us create these index beating returns time and time again. So go small if you have to go big. This is just an explanation of that, how we can slowly start building up positions and still make big returns. So what we try to understand here is that risk reduces not because the price is low. The price is of course higher, but even the conviction is higher. And since the conviction is higher, that is why we are allocating more to it, right? So initially the risk is high and thesis is just forming, so we go small. Then the risk reduces, breakout is confirmed, so we add more. The earlier profits are starting to cushion the downside, we add more. Now there's a strong trend, demand is clearly visible, we add more. And when the winner is identified, we just have to ride it with even more allocation and take our allocation to the highest possible in such a way that we still have enough margin of safety for any to avoid any sort of negative compounding. And that way, we are really reducing risk if you think about it. And that is not because of a lower price, but it is because of a higher conviction. Next secret is control your controllables. And this is not just related to stock market. This is a life philosophy that we should always control our controllables. Very easy to understand, but very difficult to implement because we have a monkey mind. It always wants to control or at least worry about the non-controllables. But whenever there is a situation, we always need to think about it that why are we worrying? Can we do about it? So let us do that and stop worrying. If we cannot do something about it, then what is the point of worrying? So we should always control our controllables and we should never worry. We should just see that what can we control and we should act on that. So macros are not in our control. What will the government do? Management do? How the raw material price will fluctuate? Not in our control. Stop worrying about that. What we can control as an investor, we can control the position sizing. What are we putting on the table in a particular position? What is our risk management? What are our exit criteria? And how are we allocating? Are we allocating to winners or are we allocating to our losers? These are the only three things we control as an investor. A lot of times, because we are not here for adrenaline rush, we are here for making more money. So it is so predicting gives a rush that okay, I was right. But what will make you money is how have you controlled your controllables, that is position size, how have you managed your risk, and how well have you allocated to your winners. So this completes chapter number 12. Chapter number 12 is more about the different cycles, the stories, and the nature of the market. So Secret 27 says that there are cycles within cycles. So like we saw the example of Maslow dog, on a daily chart, exit happened because there was a change in cycle that from advancing stage, it entered into a consolidation or a basing stage. And then there was a fresh breakout. It entered into a new advancing stage, and then it found a base, again went into stage three, and maybe slight stage four at some points of time, and then again it entered into stage two. So if you go on a daily time frame, that was also cycle playing in Mascot. But if you go on a weekly time frame, then also there is a cycle, and those stages of stage one, two, three, four are still there, but now it is a longer cycle. And when you go on a monthly time frame, so that way Masgondok never came out of stage two on a monthly cycle. So is it a structural story? Might be, but probably not. And even when we think about the core compounders, FMCG kind of plays, and Nestle's and HULs of the world, even they are cyclical. It is just that their cycle is longer. So what I mean to say is that there are cycles within cycles, and we, as an investor, we have to see that which cycle are we interested in. Accordingly, we have to position ourselves, and accordingly, we have to play those cycles. Smaller cycles will give us faster churning. Longer cycles will give us slow churning, but it will give us more time, which will also help with the compounding. So just to understand this in simple language, everything is cyclical. We just need to understand it, what kind of cycle it is, and even if the company looks less cyclical on a longer time frame, still there will be smaller cycles which we can keep playing on lower time frames if we want to. And to just show example of like we saw in Eicher motor charts, that in daily chart there are short-term cycles because a lot of noise is there. So what is happening? Positive news is there, company enters stage two. A negative noise is there, it comes out of the stage two. This will happen in a daily chart, that it will be noise and news driven. In intermediate cycles, what will happen is that the impact of noise and news will be lesser, but it will still be there depending on how strong that news is there. For example, on a daily chart, the CEO is reassigned, might help uh, changing the cycle. But on a weekly chart, a PLI scheme is coming, might help change the cycle in a weekly chart. But on a monthly chart, what will ultimately change the cycle if this the relevance of this product is increasing or decreasing. So that way, there are cycles in all the time frames, but the triggers which will help a company go from one cycle to another cycle will depend on the time frame as such. So the stock is the same, but the cycle then depends on the time frame. Secret number 28 is my favorite. It says that a stock can change your net worth only if it is in your demat. So knowing is not enough, watching is not enough, and even being right is not enough. Even if you know, even if you have seen that, okay, this is happening, and even if you are right in predicting that, okay, this might happen or this might not happen, but what did you do with it? If a stock is in your demat, it is going to change your net worth. If it is not in your demat, it is not going to matter. And it works two ways. If we think that we have to invest in a particular company and we invested, so now it will positively help us compound. But it also works the other way. If the market condition is very bad or the stock is correcting, say for example, say Cochin Shipyard. If somebody had Cochin Shipyard in the portfolio, it corrected say 60%. If we sold at 10% or 15% from top, we might have lost that 10-15%. But once we sold it, would it have mattered that it corrected 60%? No. The moment the stock is out of your demat, it stops mattering how low the stock is going. And same way, even if we know that a certain company might do good, but certain sector is in favor, but if you do not invest in it, it is not going to positively negative. So again, very simple thing to understand, but sometimes a lot of things go in the head and they do not reflect in. So this basically can help one bridge the gap between knowing and doing. And just explaining that we can essentially be following just a three lever system, that as an investors we can have three things. Either we can have a lever of cash, or we can have of exposure, or we can have a lever of exit. So that is it. So cash is a conscious choice. If we are maintaining some sort of cash, we are using it as a protection lever in say sideways market. When the market is in our favor, we are increasing our exposure. So that is the compounding lever. And when we think that everything is broken and the market can go very down or whatever we think, at least it might be prudent to exit altogether, at least save from some portion of a portfolio, say from satellite portfolio. So these are the three levers that we can pull: cash, exposure, and exit. And wherever we do that, whatever is happening in the market stops mattering for us, because either the stocks are now in our demat or out of it. Next secret says that trends speak. Whenever there is a trend, it is saying something to you. We just need to listen more carefully to it. So whenever the price is correct, is not changing, it is moving sideways, and the earnings are rising, but the price is still sideways, earnings are coming. So that means that the stock is undergoing a time correction, which means that valuation is normalizing as the earnings are growing, because the price is same, earnings are growing. So the PE multiple is actually going down, and that way there is a time correction going in. So even if the stock does not do well for a long period of time, will it not do good later? It will probably do when the valuation normalizes. So that way, even the sideway trend is speaking something to us that, okay, keep me in the watch list, or at least set a trigger or a GTT the above the consolidation price, because the earnings are consistently coming, and the market does not want to derate me. I'm there, I'm correcting with time. So that is what the stock is telling you. When the price is correcting too much, that means there might be institutional exits. And now the price correction is happening, not just time correction. And whenever the stock prices are appreciating very swiftly, that means the market is pricing in growth and future earnings. Even if the earnings are not there yet, but the price is moving, that means future earnings are anticipated that they will be good, and the market is probably re-rating the stock. We have to understand when is the time correction happening, when is the company being derated, and when is the company being re-rated. So the trends are always speaking to us. Only it is just that we need to listen to them. Secret number 30 says that we can use shorter term moving averages for trading explosive stocks, or we can also sell into strength. So a lot of times what happens is that when the stock moves too fast, like it moves very swiftly up, so it tends to extend from the EMA. And there is always a tendency of pulling back to the EMA eventually. So now suppose if the stock broke out here and it doubled in no time, say doubled in a month, or it doubled in say 2 months. So now there are two ways to look at it. One is that it is moving fast, it is moving up very fast because one, the trigger is very strong. That might be the reason. Or another reason might be that the liquidity is less. There is a strong trigger and the liquidity is less, because of which the price moves volatile, has a very volatile movement, either in upward direction or downward direction. So that might be the reason. So what is the way out? So one way is that we can sell into strength, and William O'Neill has explained beautifully what is selling into strength. One can do a research about it. Somebody wants to practice that. So either we can sell into strength because the compounding is already taken care of itself. We want 25% compounding in an year for great returns, and the stock has already doubled. So it might make sense to sell into strength and just book profit and be ready if the base is forming, so we can re-enter, or we need not even kick ourselves that, oh, I sold and the price is now moving up, because anyway we booked some profit and it is fine. Another thing, what we can do is that if we have to trail the stop loss and we want to ride the trend fully, so we can use a faster EMA. Instead of using a say 50 EMA here, maybe we can use a 5 EMA or a 10 EMA or a 20 EMA maximum, because we know that when this has moved up very fast, it can also come down very fast because of the phenomena called mean reversion. And that way we are simply trailing ourselves, not below this, but somewhere here. So same stock, if we trailed here, we will still be able to lock in a lot of gains. And if it doesn't trigger, say, any of these, then we can keep riding it. Secret number 31 says that market is not a math problem with one right answer. So it is an extension to the secret which says that there are 100 paths to nirvana. So similarly, it is an extension to that, saying that market is not a math problem. So instead of trying to solve the market, we need to position ourselves. We need to understand that what is the story. We need to understand the stories of the economy, stories of the sectors, story of the companies, stories of the management, and we have to accordingly position ourselves. Market is all about stories because it is always future looking, and it does not have that, okay, earnings are good, price is gonna be good. It is not like that. Market always anticipates the future, and accordingly, uh, the behavior in terms of prices there. So since it is not x is equal to x, y is equal to y kind of thing, so there is not one answer, and we should stop trying to solve it. Instead, what we should be focused at is earning more, saving more, investing more, and positioning ourselves in the positive stories, in the compounding stories, in the stories of growth. We are very near to finishing up the secrets, and then we will come down to discussing how we can think about compounding as a concept beyond money. So the secret says that market cap drift is the silent disaster after a market correction. So just think of it this way, that somebody was exposed in small caps and small caps started getting butchered. The person did not exit. Then the mid caps start to falter. The person did not exit. Now the large caps have started to falter. Meanwhile, small cap may the portfolio is down 60%. All the exposure was in small cap. The person did not have any sort of exit mechanism. Ideal case would be to have diversification in terms of market caps, and having a robust exit system. But suppose if somebody did not have that, the correction is already done, the damage is already done. 60% portfolio is down. Now the person thinks that I should sell everything. And since large caps are corrected 10%, while small caps are corrected 60%, let me move to large caps because caps are stable. Large caps don't fall that much. But the truth is, the thing that falls much also goes up much. So if we try to change the market cap after a market correction, that is the biggest mistake one can make. Having no exit system was mistake one, but changing the market cap after the market correction is the biggest blunder one can do, because it is like participating in the downside, selectively avoiding the upside. So ideally, whatever downside of 60% is there, it will also be taken care of with due course of time. And then even the small cap and mid cap indexes will eventually break out and go up. So what was supposed to be minus 60% will also become plus 60% eventually. And what was supposed to compensate for this fall, we are avoiding that by changing the market cap, and we are selectively choosing the correction. So unknowingly, this is the biggest blunder one can make. So if somebody is there listening to this, that they would have had just small cap, mid cap portfolio, and a lot of fall was there, don't think about changing the market cap right now. Once the portfolio stabilizes, once everything recovers, and once you are in a good position with good margin safety, then think about diversification into different market caps. But let the upside balance your downside first, and then take the rebalancing decision. So this completes chapter number 12. If there are any doubts so far, so maybe we can have a quick discussion. Otherwise, we can move forward.
Nimish, secret number 30, can you please explain it once again?
Yes. So secret number 30 was selling into strength or using smaller EMS, or say faster EMS, shorter term or faster EMS. So what does this mean is, suppose a stock has broken out and it moves up very fast. Now there could be two ways of thinking about it. One thing is that it has gone up very fast because there is a structural trigger. Say Cupid, for example. Cupid went up very fast, but probably it has a structural story because now it is becoming a FMCG company. There is a transition from, say, a B2B company. It is now becoming maybe a brand. It is now, so that way it can, market might want to give it a higher earning multiple, but it has moved very fast. So one way to look at it could be that there could be structural change. On the contrary, there could be something as, say, Axis Skates, or another, we can take hundreds of examples for that, like, say, Premier Explosive or something like that, that the prices again moved up very fast, but that move might not be very sustainable. So as an investor, there could be two possibilities. Either there is a structural trend or there is not. So that is the reason we do not preempt anything, but we always trail our stop losses, right? But we do not want to give back a lot of profits also, because the prices moved up very fast. It will also come down very fast. It might happen, it might not. But if it comes down, it also comes down very fast in certain companies. If the price appreciation happened because of liquidity and not because of growth trigger, or the longevity of the trigger. So that is what. So what we can do as an investor here, if we do not want to get involved in all these things, one is, what we can do is we can simply sell into strength. That our position has become doubled. Say we book 50% of it. So that way we have clocked in 50% profit. Now 50% we are riding it as per our exit system on a weekly chart or whatever, right? So that is selling into strength, and you can read more about it in William O'Neill book, or just Google it up. You'll get all the details. Second thing, concept could be that if we do not want to make any sort of premature exit, and because of which we are not selling into strength, then we can simply use a faster EMA. So what will happen is that instead of using 50 EMA, we might be using 5, 10 EMA. So whenever this EMA is getting breached, instead of this EMA, we are anyway getting an exit much earlier. So instead of waiting for a 40-50% drawdown and then taking an exit call, we can simply take an exit call after, say, 10-15% here. So there are two. So putting everything, simplifying everything. If a stock moves up too fast, either we can sell into strength, or we can use shorter EMS for trailing a stop loss. Now, does that make sense? Yes, Ajay, you have raised a hand, please.
Yeah. So coming back to
Yeah, it's clear, Nimish.
12
Thank you.
number. Oh, can you hear me? Yeah.
Yes, sir, I can. Please,
Okay. Yeah.
please go ahead.
Coming back to slide number 12 about capital. Don't enter at the lower capital, sorry, the market capitalization. Yeah. So
This one, sir?
sorry. Yeah. 32. Yeah.
Yeah.
No. After that.
Can you please tell sir exactly what you want
My
to discuss?
question is that this say when the market cap is lower,
Hmm.
then what I understood is then don't enter. Is that the thing which you're trying to convey?
Probably sir, you are talking about this. No, I'm not saying that when the market cap is low, don't enter. What I'm trying to say is about more related to market cap drift. So
Okay.
what I meant was that suppose understand it like this: small cap, mid cap, large caps. Right?
Yeah.
Small cap companies have more room to grow because they're very small in size,
Right.
but they also have very high amount of risk.
Yeah. Risk. Yeah.
Mid caps have a relative lesser room to grow because they're already big enough. Say 10,000 crore market cap, not very small, but still smaller than lakhs of crores of market cap. So those are mid cap companies. They have room to grow, but the chances of mid caps getting bust is lower, right? And
Yeah.
large cap companies, chances of getting going bust is lower, but then the room for further growth might not be that much. Say, consider the Reliances of the world, right?
Right.
So that is because of the nature of the size of the company, that small cap companies tend to go up very fast and tend to come down very fast.
Okay.
Mid cap companies tend to go up very say fast, not very fast, and come down fast, not very fast. And large cap companies tend to go up slow and come down slow. So if we are talking about the index level thing, because right, there are of course exceptions. Large cap companies can also move very fast, and small cap companies cannot. But what I'm trying to say is that suppose if somebody was invested in one particular market cap, say small cap companies,
Yeah.
when the index is correcting, generally what happens is first small cap index gets butchered, then mid cap, and then large cap. If this is the scene, of course it depends on the earning, but if this is the scene, considering what will happen is first large cap will recover, then mid cap, then small cap. But once the small cap recovers, it recovers also very quickly. So you can also practically try to see this in the current market environment. First, small caps got butchered, then mid caps got butchered, then large caps got butchered. Now, first Nifty is trying to recover, then mid cap, then small cap. It might happen slightly here and there, but eventually, what will happen is that once things stabilize, even if the small cap companies would have corrected 60% at the portfolio at the index level, that index also tends to correct. So
Right.
ultimately what happens is a price will come up if the earnings are there.
Yeah.
A price will not come up if the earnings are not there. It will essentially be tracking earnings on a broader way. But what is not a right thing to do is that we are changing the market cap of our portfolio after the correction. So
Oh,
you
okay.
were invested, say, 10 lakh rupees in small cap companies. It has become 6 lakh rupees because of the market correction. But this is not because of the company issue. This is because of the sentiment issue.
Right.
Now you have already lost 4 lakh rupees. After losing 4 lakh rupees, now you think that I should invest this 6 lakh rupees in large cap companies. So large cap companies might now, since they were corrected 10%, they might also go 10, 20%. So
Okay.
instead of going from 6 lakh rupees to again 10 lakh rupees, you might end up going at say 7 lakh, 8 lakh rupees. So that way you lost those 3, 4 lakh rupees.
Okay.
That
Okay.
is the essence I'm trying to make out.
Okay. Thank you.
That,
Thank you. Yeah.
yeah. So ideally we should be, diversified in all market caps. But even if we are not, and we should be taking exit decisions wherever there is a negative sentiment to avoid all these complications. But if somebody did not exit and somebody was concentrated in the market cap and the correction has already happened, so the point is that if we try to change the market cap at the point of correction, then we are booking that loss for a permanently. That is a permanent loss that we'll be booking. And we'll be switching to it is like, say, uh, consider like riding a bike and a truck, right?
Yeah.
So we were riding at very fast on a bike and it hit. So we thought that maybe let me move to a truck. So a high racing bike will not be able to compete with a truck anyway. If we embrace the risk of bike and we want a reward of bike, that will come through bike only. So that is what I mean
Yeah.
to say.
I've seen some people after the crash, they say, "Oh, now I'm getting out of stock market, putting the money into FDs, for example,
Hmm. Yes, yes, that is precisely what I'm talking about.
or moving to gold, or something like that."
Yes, yes. So corrections are natural, and we need to understand the difference between correction and an issue in the company as such. And that way we should be taking our decisions, not that it has gone down. That is no reason to sell. If it has gone down because there's a degrowth in the company, then we should sell and re-enter into a stronger company.
Right.
Yeah.
Okay, thanks a lot. Yeah.
Thank you so much.
Yeah.
I hope I was able to justify.
That's my doubts are cleared.
Yes, thank you so much. So on that note, let us move to the last, second last. I think there are a total of 14, 15 chapters. We are at chapter 13. So in this chapter, we try to understand the difference between cheap traps and multi-baggers, and how to move from cheap traps to multi-baggers. So first, secret number 33 says that we should be chasing earnings and re-rating separately. So we anyway have a beautiful concept of core portfolio and satellite portfolio uh, for this particular concept, where the price tends to go up because of two things: either the earnings are compounding or the company is getting re-rated. So all our core like companies are like proven, they have proven execution, they have strong fundamentals, and they have long-term growth. So they are like grown up banyan trees. But does that mean this banyan tree cannot grow further? It can. The roots can go deeper, the branches can go wider, right? And in particular in banyan tree, these roots are also, they come upside down. So it, even after becoming a full, what looks like a full grown tree, it has room to grow further. So that is a core portfolio companies. And how these companies grow? They grow because of growing earnings. What kind of companies are there in satellite portfolio? They are emerging businesses, platform companies, cyclical companies which have cyclical upswings and downswings, and they have a relatively faster cycle. So think of them like small plants which have an opportunity uh, to become a tree eventually, right? So some satellites can eventually become future cores of the company. So what I try to highlight here is that the core portfolio provides stability in the portfolio, and satellite companies create an alpha because core is tracking earnings and satellite is tracking re-rating. So that should be our lens to think about it. So in satellite portfolio companies, what we are there for is the re-rating. Once the re-rating is complete, exit is triggered on weekly, we should exit. Now, if we think, yeah, that it will further, anyway, the business is there, and it is bound to grow, it will make more profits. But the re-rating is done, and now probably that cycle is changing on a weekly. So we should not get too much stuck in expectation of future earnings, because we were there in satellite portfolio for chasing re-rating, which we have already done. So that alpha is created, we should exit and re-enter in the next company. So in satellite portfolio, we should be chasing re-ratings, and in core portfolio companies, we should be chasing earnings, right? Even if they are not getting re-rated, but earnings are coming, we should still stay in satellite portfolio. Earnings are there or not, doesn't matter. The stock is getting re-rated, we should enter, we should exit. That's it. So this uh, clear mental division will help us avoid emotional biases. And if we get more earnings in satellite, it's a plus. If we get more re-rating in core, that is also a bonus, right? So this secret simply emphasizes that core portfolio companies track earnings and satellite portfolio companies track re-rating, and hence they should be tracked separately because they are tracking two different things. And the slide again re-emphasizes that returns essentially are a multiple of earnings growth and PE ratios. So in core companies, PE ratio is almost the same, but earnings are growing, because of which they are growing. And in satellite like turnaround companies, there is a possibility of re-rating and earnings are also catching up. So there is a multiple expansion happening here, because of which satellite companies tend to move faster. So both earnings and valuations matter, but their weight differs. In core, earnings have higher weight, while in satellite companies, the re-rating or the PE multiple has a higher weight. Next secret is that cheap is often dangerous. We should not be buying any company just because it is cheap, because there are a lot of ways because of which the company might have become cheap. If there is a market level fall and the earnings are intact, then it is definitely an opportunity to accumulate. That is the reason why we accumulate core companies in market falls and avoid satellite companies, because the proven companies, it is easier for them to come back and start earning again because the compounding engine is very robust. But particularly in turnaround or smaller companies, when the corrections happen, we should not you know stay hopeful in those companies and just keep staying there and maybe buy more or average down because it looks cheap. Because what once used to look good, it is not necessary that the past winner will also be a future winner. Think of DVDs, think of USBs. These technologies, how much promising they might have sounded, 10 years back, have the brother. I was unable to, you know, I was unable to understand, grasp, or believe or accept this truth that my laptop does not have a CD driver. It was very hard for me to accept. But the fact is that the technology did change and it has become now obsolete. So we are living in a disruptive and changing world. So what used to look good might not be the same. So if a company is cheap and it is cheap because of a fundamental issue, it might often be dangerous and not be actually cheap. What is cheap? Then then the question is, what is cheap? What is cheap is that we should not try to catch a falling knife, that the price has gone by down a certain percentage, that is the reason for us to buy. That is the wrong approach. What we should be seeing is that even if the price has fallen too much, we should not be thinking ke aur kitna jayega, it can fall further, we never know. So this is a value trap. Even if the stock is corrected 50%, it still has 50% more to correct. It will depend on how the company is behaving. So this is not cheap. Whenever the price is falling, it is like a falling knife. We should not try to catch a falling knife, otherwise, we'll end up cutting our hands. Value will emerge once the stability happens. So, once the price is corrected and now it is forming a bottom, after bottom formation, now it has moved up, say, 10 to 15%. This is precisely the low cheat area. So, this is a value buy. This is a value trap, and this is a value buy. So if somebody has to do value investing, instead of trying to hunt for stocks which are cheap, we should try to hunt for stocks which are stabilized after the correction, are trying to turn around, have moved a meaningful 10 to 15%, are offering maybe a low cheat pivot level opportunity. And that is the opportunity. That is the point to get interested. And that is actually actual value. So that is what differentiates a value buy from a value trap. Secret number 35 is that not every breakout is a multi-bagger, but every multi-bagger once broke out. So if there is a breakout, it is not a sure shot phenomena that this is going to become a multi-bagger. But think about it. Whichever multi-bagger exists, some point of time it did break out. Because if something has to move up, it has to first break out of a base and then move up and then move up again and then move up again. So if we have to hunt for multi-baggers, we need to buy breakouts because future multi-baggers will also break out at some point of time. But if something is breaking out, does not mean it has to be a multi-bagger. It can be, it cannot be. So how to think about it is that we need to position ourselves for breakout entries, but not be hopeful. Instead, we should be reactive. If the stock is becoming a multi-bagger, we should add to it. If it is not becoming a multi-bagger, we should simply exit a position, say bye-bye, move to the next company. So the multi-bagger method is actually very boring, that we keep buying breakouts and turnarounds. And some of those companies will become multi-baggers. And if we follow the tranching system, then we will be heavily invested in those multi-baggers. And whichever is not becoming a multi-bagger will simply get out of the portfolio. So it is as simple as that, that if we have to hunt for multi-baggers, we need to buy breakouts, but we don't have to, push ourselves for making every breakout opportunity a multi-bagger. Next secret is that everything is risky. If we think anything is safe, no, even FDs are not safe. Even we sitting inside a house, it is not safe. Anything can happen. Anything can go wrong. Buildings also fall. What looks like a very safe environment is also risky, right? So what is the illusion of safety? So ask someone if they want to avoid, why do they avoid stocks? They will usually say that stocks are risky, right? Yes, of course, stocks are risky, but in there, but that risk is not. But what? Are the same person that how are they putting their money? So maybe they will have one piece of land, or they will just have one business, or they will just have one job, or they will just know one skill. They will just have one source of income. Isn't that risk? What happens if nobody is interested in buying that land? Today, one area in a city was growing. You bought a land, but that growth shifted to some other portion of the city, and now that area is becoming popular. Your area is not getting popular because of which the anticipated multiple you expected is not there. Similarly, in business, you are doing just one business, and the industry is getting disrupted. Similarly, in job, you're just doing one job, nothing else, and you lose a job. Isn't that risky? You know just one skill. Suppose if somebody knows how to paint and say for some reason there is some issue because of which he is unable to paint. So isn't that risk? If you're dependent only on just one source of income, isn't that risk? That is also risky. So yes, stock market investing is risky, but these risks are higher because these risks do not expose us to the optionality of upside. So that way, if you think about it, everything is risky. We just need to be cognizant that which thing carries what risk and mitigate that risk. Avoiding of risk will never give you returns, but mitigating risk will. Okay. So what we need to understand is that whatever risk we are taking, is it worth taking? And is the downside survivable? If the downside is survivable and the risk is worth taking, that is, we have a good risk reward ratio. So this is the game we should be playing, essentially. So this covers up all the secrets that I have shared in the book. So we started with understanding what is compounding, why it is not popular. Then we saw different instruments giving different returns over different periods of time and seeing the breaking down the formula. And then we talked about a lot of secrets that could help one refine the process and improve the results. Finally, we are at the last part of the book, which talks about life compounding. So it says that finance features compounding, but life proves it. So, of course, compounding is a financial concept, but if you think about it, it goes beyond money, and life proves it in all the spheres. So, this chapter is all about it, compounding beyond money. So, I think we'll take just hardly 10 to 15 minutes, and then if there is any feedback or question, then we can have a discussion and wrap this up for today. So the big idea in this part is that money is just the easiest form of compounding to measure because it is measurable. But what we are often unable to measure, but it has the same phenomena is our skills, our health, our reputation, our learning, our habits, and character. All these things are actually obeying the same law that small repeated actions multiplied by time, these things create disproportionate outcomes. Now, think about it. When Sundar Pichai became CEO of Google, it was a shocker to everybody that, okay, that an Indian is becoming CEO of Google and the original founders are appointing him as a CEO and they're moving off from the CEO position. So did it happen overnight or because of years of engineering depth and deep level product thinking and communications, which everything stacked quietly. All the learning, all the experiences, all the reputation that he has built in the firm, the way he handled people, his depth of engineering, and all these things, product thinking, communication, everything actually stacked. And one day he became a CEO and he came into highlight. But he, even before becoming a CEO, wouldn't he be doing exceptionally well in the company? He was absolutely doing phenomenal in Google. It was just that we did not know about it. And his skills over the years, since childhood till the day he became CEO of the company, all of them compounded. Similarly, if we think about Virat Kohli, so his edge in cricket comes because of his health, not just because of his skills, but also because of his health. And it is actually, Virat Kohli initiated this movement of the whole team becoming really fit and creating an edge with fitness. And that those early investment in fitness before even if it was fashionable, his early investment and consciousness toward staying very fit actually helped him get an edge in his career. So his health also compounded at it. Similarly, if we think about Ratan Tata, so his influence was not built in a day. It was built through decades of ethical decisions. He took those ethical decisions and restraints through decades, because of which his reputation compounded, and he became a legend when it comes to reputation. Today, also people trust Tata with the same amount of, it holds the same reputation even when Ratan Tata is no more. But the brand carries his legacy. That is because of decades of his ethical decisions. Similarly, learning compounding, if we think about Charlie Mungers and Warren Buffett, they're multidisciplinary reading. They not just read about finance and stock markets and annual reports. They read in multiple disciplines, and their habits of reading in multiple domains, that allowed them to recognize patterns which others tend to miss. And since they took part in those patterns, their learning also compounded, and that compounded learning actually helped them compound the money. When Satya Nadella first, entered into Microsoft as a CEO. So that time he initially, did a lot of cultural changes in the company. So those changes looked very insignificant initially, but over multiple years and over, a lot of, when he gave um, those changes sufficient amount of time, so that helped in creating a character compounding for the companies, and it created cultural moats in Microsoft, which is like very hard to beat as such. So his empathy and humility created cultural moats, a strategy which, any strategy couldn't. So that is how compounding looks in character also. Next chapter is the infinite game. So like we were discussing, imagination is the only limit we have. We are living in a beautiful time, in a beautiful country. We are in a beautiful community, and it is just that we need to, broaden our horizon of thinking, and that is the only limit we have. And if we really have to play this game to its full potential, we need to teach our children the power of time, and we need to teach them early. We have to teach our children early about these concepts, and we have to make them understand the power of time, that how time plays its role in various domains. We need to have a global mindset to play an infinite game. Suppose if something goes wrong in India, the government changes, the focus shifts, and something happens, and the markets become, terrible. The growth hampers as an economy. Instead of going up, we start going down. Still, we have the optionality of going global, right? So somewhere in some part of the globe, growth will still be there, and we should have that global mindset if we have to really play that infinite game. Suppose if, say, Indian markets do great for 30 years, but we were discussing about 60 years of compounding, and then Indian's market stop performing, we can simply switch to next market. We can maybe start investing in Singapore if it looks good. We can start investing in US if it looks good. We can start investing in Sri Lanka if it looks good. Yeah. So that is developing a global mindset. And even in a business, we are living in a world that, for our education, we should think globally. For our jobs, we should think globally. For our businesses, we should think globally. And even for our investments, we should think globally. So that is what will help us, play the same game continuously. If something falls off, we simply switch to another opportunity globally. Next is that our imagination should be disciplined, should be anchored by discipline. Right? We should, think really big, but we should not just be thinking big. We should also be taking actions, and we should always be taking disciplined actions, because that is going to bring about the change. And we should, even when it comes to habits, it is not just one single habit. We should think about, we should actually be developing a habit of building new habits. So first starting point is to understand the importance of building habits, because habits is something which repeats, and what repeats starts creating massive outputs. But what if we start building a habit of building new habits? So today we are focusing on stock market investing. Tomorrow we start focusing on our health. Third day we start focusing on our relations. Fourth day we start learning on AI. Fifth, that way. So we can just build a habit of building new habits, and we can be focused at where is our time getting spent, what are we doing, and how small actions we can, tweak in our daily routines, so that each action starts compounding. So essentially, if you think about it, there are limited options still available, but it often comes with infinite possibilities. Think about say 12 notes in music, just 12 notes, and infinite melodies are there. So same way, whatever options are available, it is just that there will be still a lot of permutations and combinations. So if that way we think about it, we can play this game bigger. Then still, it is, everything looks good while reading it and on paper and while discussing it. Still, there are certain limitations of compounding. Not everybody will make the returns discussed in this book and in presentation. So, what are the limitations? The limitations are our behavioral biases. The limitations are life itself. Life happens, and somewhere we lose track. What is another limitation? The limitation is a lack of discipline. The limitation of health is there. That is the biggest limitation one can have. We have limited bandwidth, we have limited hours. So all these things are limitations in compounding. But if we try to structure our thought process and our habits and we try to basically choose the right games and just keep playing the right games, still we can make really big in life. And last thing that I've talked about is in the book is compounding of thoughts. So all of us understand the importance of thoughts, right? Even in Strangest a Secret, this has been emphasized time and again that we become what we think about. What we think is what we do. But and we have also been learning about compounding. But think about it, even the thoughts compound. So compounding is not just what is compounding. Compounding is that one thing, two, three, four thing, and everything stacks together and it starts creating a J curve. So think about it like a line of thoughts, not just thinking in one direction, but uh, developing a habit of thinking well. And when we think well, when we think positively, everything starts making a shift. First, we say rectify our finances, then we rectify our health, then we rectify our skills, we rectify our career, we rectify our reputation, and whatnot. Matlab, Um, it is truly limitless, actually. So first we think, then we do, and then we become. So it is about from knowing the journey from knowing to doing and eventually being. So that is the whole journey. So the bottom line is that what we think is what we become. So if we need to do anything meaningful in life, we first need to be very cognizant of our thoughts. And if our thoughts are positive, even our outcomes will be. So these are different assets, but the law is same, compounding. Money is the easiest thing that we can measure, but the mechanism is same everywhere that small deposits repeated create non-linear results. Like reading 5 pages of book, doing 15 minutes workout, practicing guitar, say 15 minutes, doing push-ups daily, eating 80% of what our diet should be, choosing our company well, prioritizing, planning, all these small things which look very small initially. If we keep doing the small deposits and we keep repeating it for over a long period of time, it helps create non-linear results. And I would like to give a 9-day challenge or commitment to everybody that pick just one any non-financial domain, pick one daily deposit and just do it for 90 days and see what happens. So the infinite game is a horizon shift. Life is too long to play short games, and most of the people are busy playing these short games in long lives. We are stuck in the small arguments, the small constraints of life, the temperature, and whatnot. So, but life is too long to play these short games. So we should be playing longer games in this long life. We should be building assets. We should be understanding the value of time, teaching children the value of time. We should keep our options open. We should think globally, build optionalities through skills, relations, and mobility across cycles. And we should try to beat the limits and we should understand what are our guardrails that will help us do the compounding well and how can we neglect impatience, inconsistency, emotional sabotage, and over optimization. How can we avoid these and guardrail our compounding? So that is the final note. And at last, I've given a bonus like a daily checklist, say 9 to 10 questions. These questions can differ for somebody, but to give you a context, one can actually create a simple checklist in phone. That image also I've given in the book. how I have created it on my phone, a simple checklist where I'm not very fussy about what I'm doing in my day, but I just try to be cognizant that did I work on my mindset today, even a little, that is okay, but did I work on it? Did I do something about my health today? Did I learn something? Did I grow something? Did I grow my business? Did I grow mentally or emotionally? What did I take any actionable step for towards my wealth? uh, did I do anything about being, having content relationships, being grateful? Did I do anything for elevating myself spiritually? So I just maintain a small checklist. I'm not fussy about it, but it is like a lighthouse that keeps me focused that, okay, there are multiple domains I need to focus on. And each day we have to do it very peacefully, just small things here and there, and everything will eventually compound into something big. Yeah. So this brings me to the end of the book and the end of the presentation. And I've ended it on a note that we are holding a seed right now. So just plant that seed, tend it, and see what grows out of it. And the best time to start compounding was years ago, but the second best time is now. Yeah. So that is all from my side. And if somebody has any questions or like to discuss something, we